Welcome to this episode of our 3-Minute Investment. We help you easily understand the financial reports of popular companies. Is Boeing back from the brink? Or is the turbulence just getting started? If you are watching the aerospace giant from the sidelines, the signals from late 2025 are confusing. On one side, you have the operational reality. Factories are humming and planes are flying off the assembly line. But on the other side, you have the financial reality, a balance sheet that is still bleeding cash. Let's decode the actual numbers from their latest financial reports to see what is really happening under the hood. First, look at the headline number, 600. That is how many commercial aircraft Boeing delivered in 2025. This number is critical because it represents the highest volume of deliveries since 2018. In manufacturing, volume is everything. Delivering more planes allows Boeing to spread its massive fixed factory costs over more units, which is the first step toward profitability. The demand is definitely there. For the first time in 7 years, Boeing actually beat its rival Airbus in net orders. A net order is simply new orders minus any cancellations. With 1,175 net orders in 2025, airlines are voting with their wallets, signaling they still trust Boeing's aircraft despite the headlines. If you walked the factory floor today, things would look busy. The 53-day labor strike is over, workers are back, and the assembly lines are moving. This physical recovery is essential because you cannot fix the finances until you fix the factory. But here is the catch, and it's a big one. Despite selling 600 planes, the company reported a net loss exceeding $10 billion for the year. This teaches us a hard lesson. Volume does not equal profit. Boeing is selling planes, but right now, it is costing them more to run the company and service their debt than they are making from those sales. How do you lose $10 billion when sales are up? Nearly half of that loss came from a single accounting event called an impairment charge. Specifically, a $4.9 billion charge on the 777X program. In plain English, Boeing had to admit that the 777X project has lost value. It's going to cost way more and take longer than expected, so they have to write off that money now as a loss. Think of it like a home renovation, where you suddenly realize the foundation is cracked. The unexpected costs and program delays mean you are over budget before you even finish. For Boeing, certification delays mean they can't deliver the 777X yet, so they take the financial hit immediately, which drags down the earnings for the entire year. Now let's look at liquidity. In the business world, we track operating cash flow. This isn't about accounting profits. It's about actual cash moving in and out of the bank account to keep the lights on. Boeing had a negative cash flow of $1.9 billion. This is what investors call cash burn, the speed at which a company uses up its cash reserves just to operate. While losing $1.9 billion sounds bad, and it is actually a massive improvement. Previously, they were burning through $4 billion, so the burn rate has been cut in half. They are effectively stopping the bleeding, but the wound hasn't fully healed yet. Looking ahead to 2026, the biggest obstacle is the maturity wall. This is a financial term for when a large amount of debt comes due all at once. Boeing has nearly $16 billion in debt that must be paid back in 2026. It's like having a massive balloon payment on your mortgage due next year. To handle this wall, Boeing executed a massive capital raise. They essentially went to the market and raised $35 billion in new cash by selling shares and issuing new debt. This acts as a buffer. It ensures they can pay off that 2026 debt and still have enough money to run the company. They bought themselves time. So is the stock a buy? The bull case, the optimistic view, rests on one word: duopoly. The world needs airplanes, and Airbus literally cannot build them all. Airlines have no choice but to buy Boeing. If Boeing stabilizes, that captive market guarantees revenue for decades. The bear case, the pessimistic view, argues that Boeing is fundamentally broken. It is a smaller company than it was in 2018, but with much higher expenses. New union contracts mean labor costs are up, and servicing their massive debt load eats away at their profits. The argument here is that the golden days of high profit margins are gone forever. Ultimately, an investment in Boeing right now is an investment in execution. Don't just read the headlines. Watch the monthly production rates. That is your leading indicator. If they can build planes faster and clear the inventory, the cash flow turns positive. It is a simple formula. Fix the factory, and you fix the balance sheet. If they execute, the recovery is real. If they stumble again, that $35 billion safety net will disappear faster than you think. Thank you for watching. Let us know what companies you want to know more about in the comment below. Please subscribe for more financial analysis to rocket your investment.